Underwriting deals is such a major pain point for people. Most don't want to do it, and the people that are good at it are few and far between. That is why after 6 years of being in the industry and buying over 1,200 apartments, using my best-selling multifamily deal analyzer, I created Real Estate Lab, a full suite acquisition software for multifamily investors. We have built a product that helps investors automate their acquisitions and close more deals, all in a cloud-based platform. You can go to realestatelab.com and sign up today using the promo code TAG2 for 10% off your first 12 months. This is David Tupin. Thanks for listening.
Welcome to The Apartment Gurus, where twice a week, host Tate Siemer brings you deep dive interviews with the wisest gurus in the apartment investing industry. These experts are sure to create game-changing value and inspiration designed to catapult your business to the next level. Be sure to reach out to Tate at www.investwithgreenlight.com for access to his investor portal and Calendly link. And now, here is Tate Siemer and the Apartment Gurus.
Welcome, everybody, back. Another episode of The Apartment Gurus coming at you right now. And we have a guru on the show that, you know, one of the cool things about this show, and most of you guys that have listened and gals that have listened to a lot of these, either you've heard me talk about how much I love doing the show, or you kind of sense how much I love doing the show. And I really do. And the thing that I love the most is getting to have really high level guests on that have done things that we all want to do, like all of you listeners and myself, as far as just having a very large record of success and have really crushing it in the apartment space. So, and sometimes I have a guest on that's like kind of who I want to be when I grow up, sort of thing, which is, I feel super lucky to get to share the stage, so to speak, with somebody like that. And today, John Cohen is on the show, and John is a Columbus-based investor. You're actually not in Columbus. You invest in Columbus, right?
Correct. Yeah, right. We're in New York. We invest Columbus, Ohio, Jacksonville, Florida, but we have a large presence in Columbus.
Yeah. So, and as most of you know, Greenlight, my team, we own 4 properties in Columbus and love the market a lot. And we'll probably talk about some unique qualities of Columbus on the show here. But John's just has just really put like I said, a large portfolio together and a large track record. John, how many units are you guys up to, and what's your portfolio look like at the moment?
Yeah, so we're going down the mountain now. We've been selling a lot of assets, but we were up to about 4,000 units, plus or minus, and now I think we're only down to, I think we're at about 1,000.
Okay.
Maybe just about 1,000, a little bit less, because we Hartford actually just closed in July. We just sold another deal down in Jacksonville, literally on Friday last week. So we are we're selling a lot, and the acquisition side's been a little bit tougher. But it was about 4,000 units at its peak.
Okay. What was the value when at its peak?
I would say probably somewhere in like the $280-ish million range, plus or minus.
Yeah. Super impressive. And so did you start selling just this last year, kind of before the market shifted, or when did you guys go into that mode?
Yeah, I think, luck have it. We started selling, I would say, shortly after COVID. We had a deal under contract in COVID. We bought 2 deals in early COVID, and then we sold one, mid-COVID. And believe it or not, those were actually the last 2 acquisitions were the 2 deals that we bought during COVID. And at that point in time, it was peak when we owned the most amount of property. So from that point on, I would say right around like June or July, August of COVID was when 2020 is when it was nothing writing on the wall or anything like that. Because during that time, our properties were really doing well. We were just getting some crazy offers and slowly started to piece them off. 2021 was a slower year. We had a couple deals that went under contract. And then so far 2022 has been our, most active year on the sales side. And, some dominoes started to fall, end of 2020, early 2021. And then, it's almost been like a snowball effect from 2021 to where we are now with our last deal in Columbus, hopefully going under contract, within the next, let's call it 48 hours.
Darn. So we're a little late on that one, apparently, huh?
Yeah.
Yeah. Okay. Yeah. So,
although it's not under contract yet.
Right. Yeah. It's not done till it's done. Right.
Correct.
Yeah. Takeaway number one there, guys, listeners. Yeah. So let's start with, share with us a little bit about your background, John, in terms of your professional journey, how you got to 4,000 units, a $250 million portfolio. How does all that happen?
Yeah, no, so for sure. So I actually started in finance. So I was working, financial advisor for, right out of college. Started that, I got my Series 7. I think I got licensed like a week and a half before the financial crisis. So that was really fun, trying to raise money and do that when, the world was basically coming to an end. Although it was pretty much at the bottom. So, it really could have gotten worse. So it was a really good time to start because, the beginning was tougher. But once people got their foundation underneath them again, it went well. So I did that for about 3 and change years. And at the end of year 2.5, going into 3, I started buying real estate. So I was able to do well enough that I was able to buy real estate for myself. I bought a ton of properties in Philadelphia at tax auctions, did a couple fix and flips, and realized that I liked doing that a lot more. So left my job as a financial advisor and said, I'm going to be a real estate investor. But you don't really make much when you first start. So I ended up just getting my real estate license, started doing sales and rentals in New York City. And then I always wanted to do commercial real estate. So I interviewed at, all the big firms and ended up picking Marcus and Millichap to focus on multifamily investment sales. And that's really when I just, fell in love with multifamily, from the brokerage side and the, real estate salesperson side. You're only as good as your last deal where,
Right.
There's no residual income from selling property. And I just saw clients that we were listing properties for and selling properties to. You had 5, 10, 15, 20, 30 properties. And, wow, this guy's got 10 properties with an average, net income of 50 grand. I'm like, wow, this can add up. I'm set. We were selling these things for 600,000 to, $2 million. I'm like, well, if I'm going to do a fix and flip buy for, 200 and sell it for 320, it's like, how much harder could it really be to go out and buy a multifamily? I knew rent control and rent stabilization laws in New York. I didn't want to do it here. And in 2013, I just said, let's do it. And I actually made an offer on a property through a direct mail campaign, Columbus, Ohio, with actually a manager you guys were working with. I don't know if you still are, but he happened to get my direct mailers and introduced me to the owner of a property who was just about to list the property. He said he was going to list the property on Monday. It was a Saturday night or Saturday afternoon. I jumped in my car. I drove 10 hours to Columbus. I saw the property, turned around, drove 10 hours home, and called him on Monday morning and said, I'll take it. And that was the first deal I bought. It was a 48 unit property in Columbus, Ohio. And started at the end of 2013 and 2014 was the first acquisition.
Yeah. Super exciting. So many good things there. I mean, we talk on the show a lot about the value of working in the industry in some capacity before you become an investor and learning the business that way while you get paid, while you make some money, and while you learn the ins and outs of really, I mean, you're going to learn the whole, if you're a sales agent or a broker in this space, or working as an assistant to, which, you know, a lot of you guys could go out and find something like that. You're going to learn so much about this business, and you'll know if it's right for you. John mentioned that he really fell in love with multifamily. I use those same exact words frequently. Like it's a asset class and an investment space that has so many unique qualities that when added together, in my opinion, there's nothing like it. And you saw that, but you caught that vision and went to town as a sales agent. Marcus and Millichap, huge national firm, very successful. And I mean, you did it in New York City, which I would think would be a real cutthroat sort of environment as far as trying to get business and listings and customers or clients and get business done. Was that the case?
Oh, you have no idea. I remember I was brand new at the firm, or just starting, and I just started my cold calling. And I remember I cold called someone that he said he would set up a listing appointment. Little did I know, someone in the office had already tried to buy the property for way below what I told him it was worth, because I was trying to get the listing. And the guy comes running out of his office and just went crazy. Who called this person? And then, fast forward 6 weeks, 8 weeks later, you're sitting in the office cold calling, doing what you got to do. You hear someone setting up an appointment for 2:30 in the afternoon, and you're scrolling through your phone trying to get there earlier, trying to get the listing before he got there. So cutthroat is an understatement. I mean, it was like a bare knuckle boxing match every morning when you get into the office, because you just, if someone was calling in your area or whatever it was, because, you had teams and you tried to keep the team environment, but at the end of the day, it's an eat what you kill business. So I remember, people just, tapping their partner on the shoulder and saying, let's get in the car, let's get to the meeting before they do. And it was, it got intense sometimes, but for the most part, it was all competitive fun.
Yeah. Yeah. It seems like it would just provide an incredible educational experience to, sell real estate in the arguably the most valuable city in the world, the most, culturally diverse city in the world. The nuances just of the different kinds of people that you would have to deal with on a daily basis, different cultures, languages, customs.
100%.
Yeah.
It was crazy. I mean, the prototypical story, for the 6 families, 8 families, 10 families was, European, Italian, some, immigrant came here working as a busboy in a pizza place, saved up, bought the building, bought the restaurant, 5 apartments above it, had enough money, bought the next building. And it was exactly that. It was, there was every walk of life, thick accents, whatever it was. And, part of it was when you would go on your listing presentation or whatever it is, you get their whole history. So the way they teach is when you're walking through the basement, you talk about the past. When you walk through the apartments, you talk about the present. So you don't want to, ruffle any carts with, tenants. And on the roof, it's like the future and what you want to do, where you're going. And you just heard crazy stories. And, guys like, oh yeah, no, I own this, and this. And, I started as, throwing out the garbage for that pizza place, which now I own. And it was fun. You just got to hear so many stories of, you name it.
Yeah. I'm just curious, kind of off topic. You live in Manhattan?
I live in Long Island. So I live, taking traffic out of it, only about 25, 30 miles from the city. Actually, I think it's 18 exactly, but traffic, it's 3-4 hours.
Right. I love New York City, man. It's such a fascinating place. I know it's changing and people talk about that, but I don't know. I've been there a number of times. I got to quote unquote live there for about 2 months one summer, and was so fascinating. Anyway, I'm sure that peaceful, quiet Columbus, Ohio, probably seemed like a pretty good place to start investing. When you were direct to seller marketing, that's how you found this deal. And you sent it to a broker / property manager that hooked you up with somebody. Were you kind of machine gunning out postcards to different markets, or were you focused specifically in Columbus?
So I had a very good friend that was buying stuff in Cincinnati, and
Yeah.
I like to be a little different. So I knew that if I needed help, he was there, but it's 2 hours away. So it was separate.
Yeah.
So at first, I picked 10 markets that I thought were, up and coming, growing, good job growth, good population growth, so on and so forth. And then I whittled that down to like 3 or 4, and I would send them out in those areas. And I think on, if you go to my Facebook, which social media is far from my forte, if you scroll through old pictures, there's like actually handwritten pink and blue envelopes. And I literally hand wrote the first, whenever I would send them out occasionally, then you use a company like that. But when I first started, it was handwritten. And I remember when I was touring another deal in Columbus, going to the property manager's office and seeing 3 or 4 sets of envelopes literally in his office. And I'm like, wait a second, those are my envelopes. And he said, oh, I've been saving them because this owner of this property was from Hawaii. He had never, he hadn't been to the property in years. And he's like, I was actually saving these because I didn't know they were you. And I wanted to call you to call that person to see if they'd be interested in the deal. So yeah, it was just, really focused on a couple of markets, but Columbus was absolutely, the top of my list.
Mm-hmm. As things evolved, first of all, that's an awesome story. It's a great way to, it's really one of 2 main ways of acquiring deal flow in the space, which is, direct to seller marketing, going to owners, and, maybe property managers and that sort of thing. And then the other way, of course, is broker relations, getting deal flow coming through brokers. As things have evolved for you, have you continued to do direct to seller marketing? Is that part of your program?
Yeah. So on the multifamily side, we've scaled that back significantly. I don't think we've sent a mailer for the multifamily side in quite some time, but we acquire a lot of vacant land, and that's a very big part of it. We send out a ton of letters to vacant landowners. But on the multifamily side, that 48 unit, and what we've seen, it's more successful on the smaller deals than it is on the 200, 300, 400 unit deals, because more often than not, they're owned by more of a professional group. We get letters all the time, and I typically just throw them in the garbage. I open them and say, oh, wow, maybe I should use that in a letter that I want to send. But I think they're more successful. We've seen they're more successful in the smaller deals. Yeah. And even more so now, because so many deals have been picked over and sold over the last 10 years that a lot of original owners and stuff like that, they've cycled out of their deals. So I don't discourage it. I think everyone should try it and do it. And it's not just send one mailer, get a deal. If you're going to do it, you got to budget 12 months, right? 7 or 8 letters, a couple of calls in between there. But I think it works. It will continue to work. It's just getting it in front of the person at the right time.
Yeah. Yeah. So, it's something we, about a year and a half ago, we at Greenlight kind of put all of our eggs in the broker basket and have really worked on our broker relationships and, getting deal flow going from brokers, either ideally off market deals or kind of semi off market deals. And we're looking right now with the shifting market at, maybe these 40 unit, 50 unit, 60 unit deals are like worth going after and worth looking at, because there's plenty of, good opportunities, mom and pop owned and operated. So yeah, it's it's a fertile space, I think. And it's one of those spaces too, for a lot of listeners, that you're going to be able to get your head around, like, maybe I can do 20 units or 12 units or 30 units, like, versus 150 units. That's easier to get your head around. And, sometimes you might have the capital yourself to do it, or you have a partner that you can JV it with. So again, takeaway there, listeners, like the direct to seller marketing thing. I'm probably going to do, I've got my buddy, Clay Rockwood coming on the show in a couple of weeks, and he's the master that I know of this whole space. And I'm probably going to do a show specifically geared at, how to do that really well. But, so I'm sure at this point you're pretty much in the multifamily space anyway, you're pretty broker oriented, I would guess.
Yeah.
Yeah.
Yeah. That for the most part, whether it's, they're all listed or they have a signed exclusive agreement, but whether they go blast it out or not, yeah, for the most part, everything is coming, even to the point where if I really like a deal, I may try and call the seller direct or send them a letter or something like that. But we'll also have a broker, like a guy, in Columbus that, we both work with. They're so intertwined in the market that it's sometimes easier to just say, hey, I really like that deal. Let me know what I can do to get it. Right. So where they're almost going to go reach out on your behalf.
Yeah.
It's
right.
just, the market's changed a little bit, but yes, I mean, we're I don't want to say reliant, but there's always a broker somewhere in the transaction, whether it's off market or on market. There's typically someone help facilitating the deal get done because they have relationships with everybody. So they're able to say, hey, we got a really good group, we got a really good buyer, or it could work. So, but yeah, our network is pretty robust at this point.
Yeah. And like that's leverage too. If you think about it, you're leveraging the experience of a broker, you're leveraging their cold calling and like, approaching sellers, and, for a 2% commission or whatever that they're going to make, that's worth, in my opinion, it's worth very much having those relationships in place, especially like you said, John, if you're going after the bigger stuff, because, like you said, those owners are typically business savvy investors, that understand the value of their property and know that they're going to get top dollar for it, selling it on the open market through a broker. So, yeah, I love this. I'm actually I'm feeling pretty inspired about this direct to seller thing. We tried it for a year and we didn't get very far with it. But I think it was largely due to our systems and processes and follow up. And did you find when you guys were really actively doing this, was, you hear people say you got to call people 5 to 7 times or 5 to 8 times before you're going to get anywhere with them.
Yep.
Did you find that to be true?
Yeah, there's so much. People have been bombarded. Now I think the iPhone actually filters unknown and known senders. So there's so many traps and ways to prevent your message from getting to somebody. And think about how many ads you get and stuff like that. So now, early on, it was definitely, 5 or so, 7, 8 contacts. Now it could be north of 12 or 15. So even when we send out mail now on some of the land acquisitions and stuff, we're typically, sending a letter, a text, a call, a follow-up, we're just trying to get in front of them as much as possible because you get so much that, and there's so many filters and spam and people don't think they know what it is. So yeah, the key is in the follow-up. It's the one, when you send a letter and the guy responds, I want to sell, it's typically not a deal, right? More often than not, he either wants too much or it doesn't make sense. It's the guy that takes 6, 7, 8, 10, 12 contacts to finally get through to, right? That's where we've seen the best results. So the follow-up is absolutely key. And it's consistency and making sure you get in front of them, 7, 8, 10, 12 times.
Yeah. I mean, that's it right there. Follow-up is key. You could write that down, listeners. And my friend Sterling White calls it world-class follow-up. Like, you got to have systematized, consistent follow-up because the goal here is that you're top of mind when they're ready to act. And if they've seen 8 correspondence from you and maybe some text and some maybe even a phone call or 3 along the way, you're likely going to be top of mind when it comes time to do something. And like you said, John, that's where the deals are, in those long game relationships, man. We mentioned this often on the show, but this commercial multifamily space is a relational game. It's a relational endeavor. And it's very much not transactional, in the sense of that you're doing like in a single family situation where you're doing one and done and you'll never see that person again. Like ideally in this space, you're working with the same people on, deal to deal to deal, whether that's, a broker, lender, you get these powerful relationships in place and you go to town.
For sure.
Yeah. Awesome. So what are you guys doing now as far as dealing with this adjusting market? You mentioned you guys hadn't acquired anything since kind of beginning of COVID-ish time frame. I'm sure you're going after stuff. Are you writing LOIs and it's just stuff's too expensive?
Yep, we're putting a ton of offers out there. It's almost to the point where I never want to say you're too knowledgeable, but like we've seen deals in 2013, 14, 15, 16 that were listed, sold. They're back on the market now at 3, 4, 5, 6 times what they were going for.
Yeah.
Earlier, and we missed them. We missed them in 2017, right? You missed the deal in 2015, and you're like, I should have, it could have worked. But, that deal was at 25,000 a unit or 40,000 a unit. Now they want, 90, 80, 130. Right. It's like, if it didn't work then with the uncertainty now, how do you really get aggressive? So we're running into that a lot. We're still putting them out there. We're putting offers out there. We're still having conversations. We're just coming up short. The biggest thing that we're working on right now is our development deal. We have a ground up construction, multifamily and single family to rent site in North Charleston, or Goose Creek, the Charleston MSA, South Carolina.
Yeah.
And that's where a lot of our, it's an awesome market. We've owned 3 deals there and that have been really, really successful. That's going to be a large chunk of our time. I mean, it's it's about $110 million development, 450 units. So it's going to be a good use of our time and resources. But we're still putting offers out there. We're just coming up a little bit short on pre-existing stuff.
Mm-hmm. On your development project, are you guys raising capital for that at the moment?
We are. We're going to raise a portion. We're obviously going to contribute ourselves. We've also had some really good exits, so we have some capital that's been sitting around for a little bit of time now. So we will be raising. We will be contributing. We always contribute to all our deals. So we'll. I don't know the exact split yet from a standpoint of how much we're going to put in and how much we're going to raise. But it's a total equity check, probably somewhere in like the $45 million range. So it's going to be a fun one. It's going to be one of our largest deals, our largest deal to date.
Yeah.
So we're excited for it.
Well, that's awesome. And you're building it to keep it, I'm assuming.
Yeah. So the intention going into it is obviously, we're 24 months out before we're at a decision point, but the intention would be to build it and hold it longer than just, a rehab on a value add deal. Yeah. Now, that being said, obviously, if someone comes knocking on our door at that point in time and it's the right time to sell, well, we will obviously take a look at it. But we are going in with all 3 options, buy, sell, buy, refinance, or, buy and hold. So we'll see how it shakes out. But we do have a little bit of a longer term horizon on this one.
Gotcha. On the equity side, when you're looking at a $45 million raise, are you bringing in any institutional sources?
That's a good question. So we're working on that right now. We've gone the institutional route for equity, and we've also gone the friends and family route. We're trying to weigh out all our options. Basically, just we were talking about it earlier. We have a great investor. One guy who would love to take down the project on the institutional side. And we're deciding, whether it's going to be, going that route or if it's going to just be, I don't want to say it a traditional syndication, but more, personal capital, higher net worth guys and seeing how we're going to go about it. With the debt world changing, we're weighing out all those options now. We're closing on the site in November. So I know we're getting close. We won't start construction until the first part of next year. So we still have some time, but the acquisition of the land will be us. We'll take that down ourselves. And then, we'll look to put that in place early part of next year, see really where the rest of the capital structure is coming from. Gotcha.
That's huge. On something like this, what's debt look like? So is there a significant difference between like a construction loan, which I'm assuming is what you're getting, or would get. But yeah, what's the difference between existing and build to rent?
Yeah, so that's something that we actually had a call out earlier with one of our mortgage guys. We were talking about that because there's another Fed meeting next week, and we were talking. By the time we start this, our loan's going to be at 10%. We don't expect that to be the case, but we're also going to go in with a little bit more equity than normal. We'll probably buy the land, and we'll start a lot of the getting ready for construction with cash. So by the time we're permit ready, we'll be pregnant in the deal, and then we'll look to go get, whatever that construction loan looks like at that time. So it'll definitely be more expensive than, an agency loan that's down the fairway. Although in today's world, I don't even know if that exists anymore, but yeah, it'll be some type of construction loan. I don't know if it's going to be, a major like Wall Street type bank, or will it be, a local lender or something like that? We're trying to put those pieces together now. Still a little early on because we're squaring away our contractor. We intend on using a developer out of Jacksonville who develops, throughout the country. We're finalizing that budget, so it's a little early to see how it's going to shake out, but it'd definitely be a little bit more expensive than your traditional loans that are available.
This is a project unlike anything you guys have really done before, isn't it?
Size wise, yes. We've done. We did build a student housing deal ground up.
Okay.
It was out of the ground, so we've done that. We've bought 100% vacant properties, but there were still walls that we could operate within. But as far as size goes, yes, development we've done. We have built, but not at this size. This is obviously the largest size we've done.
That's got to be super fun for you, John. I would think
it's exciting.
Yeah, new challenges.
Exactly. That's exactly how we're looking at it. It's something we believe in. The market is great. We love the market. We believe in the market, and it's just another hurdle that we're going to try and get over.
Yeah, I mean, putting new housing in the Charleston MSA is, as long as you're doing the deal that's right, the pencils well. That's got to, you've got a lot of hundreds of base hits there that are going to score tons of runs for you. So
then that's how we're looking at it. It's just at the end of the day, real estate is a supply and demand. The demand is there. As long as we're relatively close, we should be. We should be good. So we're excited because there's so much population growth and so many people want to be there. And there's a need for housing, so we're excited.
Yeah. On the existing multifam acquisition space, I'm curious. Do you have a team that in terms of staff or partners that helps you with marketing and broker relations, or is that pretty much on you?
It's pretty much on myself and my partner.
Okay.
During COVID, the team got small because people started leaving. They left, and that is a fourth quarter 2022 on our board of things to look to add staff, how we can divide and conquer. But right now, it's on our shoulders, just making sure we stay relevant. Even if we're not buying, just giving good feedback on why the deals aren't working for us. Like, hey, it's a little too expensive, or hey, our insurance quote's off, the debt's not there that we need. So as long as we do that, we feel really good that when the time comes, we're still going to be relevant again.
Mm-hmm. Yeah. That's awesome. I mean, you're staying in the game. You're still players. You're feedback guys. Like for listeners, like when you're dealing with brokers, timely, prompt feedback to them, no matter what their feedback is it's key, and they appreciate it more than you realize. Like their world, they send out offering memorandums and call people and send out deals and then not hear back from them at all. Like that's no bueno. Not the way to build a relationship. So let me ask you about Columbus a little bit. What, with Intel going in on the northeast side there, up in the suburbs, actually out in cornfields, what are now cornfields, $20 billion facility, 10,000 new jobs is the most recent that I've heard, but things shift and change a little bit with that because it's politically related with what Congress is doing and whatnot. So anyway, you know, obviously you and I both love Columbus. You've loved it for a long time and been there working in the market for a long time. Do you still love it, or is it starting to get too pricey, or what are your feelings about it?
Prices have definitely changed. It's a great market. It's centrally located. You have access to everywhere. You know, the airport's great. You could fly in and fly out all over the place. The diversification of jobs is, you know, one of the best markets in the country. There's no one sector that dominates the market. So you have really good diverse job. You have great, you know, you have the state capital, education, healthcare, which are three recession resilient
Huge. Yeah.
Industries.
Right.
And they do a really good job of drawing companies there. So there's good runway there. The pricing got a little sticker shock. It is still the Midwest. And the prices are reflected, you know, compared to the Southeast. But it's a great market. You know, it's you know, normally that rough and tumble blue collar, but there are some really cool, you know, really trendy locations. And I think as long as you know where you are in the city, and you buy the properties accordingly, whether it's A, B, C, or D, as long as you understand that and going in eyes wide open, it's still a market that we, you know, absolutely love. It's just we've been priced out from a standpoint of, you know, when, you know, 10 years ago it was a totally different space.
Yeah.
It's a lot different now, and we got to get with the times, I guess, if we want to continue to buy there. Also, the way that they do taxes,
Right.
not the greatest, although they did just change that, or at least propose something. We'll see how that impacts. But that's been a very tough one for us because we're very familiar with how it goes, and the old rules were brutal when it came to acquisitions.
Yeah. Taxes in the Columbus MSA, guys, are, for those of you that aren't familiar with it, are it's just a crazy climate where you've got school boards that are uber aggressive, hiring, you know, law firms to go after new acquisitions and transactions in the multifamily space, and really max you out as far as your property tax goes. So it's just something that you got to underwrite. The way we handle it is we've hired a tax attorney, a real estate property tax attorney there that underwrites our deals for us with taxes. So I'm curious, do you see any other like Columbuses in the mix as far as, you know, like what you saw 10 years ago, whether that's like a Cincinnati, Indianapolis, Louisville, maybe Lexington, any of those seem like they could become growth markets?
That's interesting. I am on the, you know, living in New York. I'm on the, you know, go where it's warmer, where the tax incentive states are.
Right.
It's tough to get really excited about colder climated areas, which all of those markets are, or even, you know, the Northeast in general. I mean, I always, when we look at markets, as long as you're on the wave, that's all you can ask for. You know, people look for like path of progress, and they try and time something so perfectly. And if you try and do that, I think it deters people from buying, because you always want to be, I want to be in the next best thing before it pops. And I'm more on the page of, you know, if the deal makes sense in a location that makes sense to you, that's not as important. That obviously is gasoline to the fire. But if the deal checks off the boxes that you're looking for, and it's a location that you like and you know and you want to be in, you could find a deal anywhere, right? It could be, you know, it could be Cleveland, it could be in the middle of nowhere, right? But there are still great markets everywhere. The biggest thing, you know, that, you know, to try and track those things is population growth, I think, and job growth. You know, with virtual working and working from home, job growth is still extremely important. But I think population growth, where people are going, they need the place to live, where they need, you know, where that is in existence and the supply and demand is in the favor. Those are the things that'll point you in the right direction to maybe, you know, get a Columbus 10 years ago. But population growth and supply and demand are the two things when looking at markets. And if you want to, you know, you want to be in a really good space there, Not necessarily like, hey, here's the next one that's, a town that you've never heard of, right? Like we're not as focused on that as we are on the physical fundamentals.
Yeah. Yeah. So, Greenlight, we look for hybrid markets, right? By hybrid, I mean markets that do cash flow, like all those markets we just talked about: Cincinnati, Louisville, Lexington, Indianapolis, Detroit, Cleveland, and Columbus, to a lesser degree, because Columbus is more pricey than all those markets, but you still can buy for cash flow in Columbus. And then the other part of the hybrid is the growth aspect of it. So like John just alluded to, population growth and job growth. Those are the things you're looking for in a growth market. And generally speaking, like you take all of the markets and submarkets in the country, they're going to either fall into one of those two categories. They're going to either be a job or a growth market, appreciation market, or they're going to be a cash flow market. And we try to be in the hybrids, the Columbuses, the Oklahoma Cities, places like that, where you can buy stuff that cash flows, you can value add, improve it, and raise rents, create equity, and cash flow, and pay investors, all along the way throughout the hold. So have you guys, when you busted into other markets, particularly Southeast and those sorts of markets, have you had to change your model at all as far as going into lower cap rate environments?
So historically, we've bought very heavy lifting, very dilapidated, where there was no, half the tenants were paying, or it was poorly occupied. So we never really had the cash flow concern. But I will say that, that's now on the board. We're not going to buy a deal at a 3 cap with a 5% interest rate on 60% leverage. Like that deal that doesn't do it for us, right? We are definitely not going to pay we're not going to overpay for a property. So where cash flow is significantly more important today than ever before, I give up the upside to have really strong cash flow from day one and forever. Because at the end of the day, cash is king, right? So I think that cash flow is significantly higher up our list on pre-existing. Obviously a development deal, totally different, but on a pre-existing deal, obviously it's going to be very important, because it's going to mask a lot of potential issues when you're cash flow positive, as opposed to having to feed the property every month. Right.
Yeah, it makes total sense. It's interesting that you're willing to give up some upside for cash flow. It makes total sense. I totally get it, but that's something I'm going to file away to keep on the radar for myself. So, John, this has been awesome, man. We're starting to kind of bump up against time here. What would you, if you could go back to that guy that, was hustling early on, in the sales world, as an agent, how would you coach that guy? What would you share with him, as far as, what you've learned since then?
Yeah. It's at the end of the day, you need a good database. Don't discount people you meet and who you know, because these deals don't always go 100% according to plan. Things are going to change, and the more people you know, and the more people that can help you fix something, that's key. So you can go in stubborn, hard-headed, and you have to take a risk. But at the end of the day, you want to make sure that you've educated yourself and surrounded yourself with the right people, so that you can fix an issue when something comes up. You have a contact or a person to call, or someone that you can rely on to fix, a potential problem, or how do you get over a hurdle? Because there are going to be tons of challenges as you go. It's just how you get over them efficiently and quickly. It makes the deal significantly better.
Mm-hmm. Yeah, that's words of wisdom right there. That's great. And then just put you on the spot one more time. What, anything that you would offer an aspiring investor that's, maybe in the single family space or in a W-2 space, any words of wisdom for them?
Yeah, do it. Take the leap. Just do it. I mean, at the end of the day, if you want to buy a multifamily or a single family flip, whatever it is, if you don't take any actions or steps or physically write the check and make the investment, it's not just going to show up on your doorstep, right? It's not going to, it's not the tooth fairy that's going to put money under your pillow. You're not going to wake up, with an apartment under your pillow. So just take, whether it's a passive investment to see how the process goes, whether it's adding value to someone that may be missing something, just take that step and make that leap. And then if it doesn't work, you just, pick up the pieces and do what you know how to do, but you got to take a shot.
Yeah. I love it. Love that. Just go out and do it, guys. And you kind of breeze through it there, but you mentioned a very profound idea, which is being a passive investor in a deal and learning the process through that deal and through that active investor that you're investing in. Have them keep you in the loop, have you include them in meetings even, and in email chains, stuff like that. That way you can learn this business. And it's a tremendous way. Look, for usually $50,000 or so as a minimum that syndicators will look at. It's not insignificant, but it's approachable for a lot of us to make that investment and make a lot of money, double your money in 5 years, a lot of times, or 3 years. But and at the same time, get a track record going and set yourself up to start doing deals. So, great idea, John. Dude, this has been amazing. Really appreciate this and appreciate you and admire all your success. And I hope that everything's really come together well for you on this ground up deal, as far as the debt and the equity and everything else that you need in place. If there's ever anything that we can do for you out here at Greenlight, we're more than happy to contribute any way we can. So thanks a lot. Yeah.
No, I appreciate it, Tate. Thank you for having me.
Yeah.
Anything I can do to help, obviously, any of your listeners or yourself, let me know.
Yeah. And what's the best way for listeners to reach you, John?
Email. If you shoot me an email, John at Toro, TOROREP.com. It's the best. I'm significantly better than any type of social media, and I'm really not good at that. But shoot me an email, just ask for help, just say you heard me on this podcast or whatever. And, with 48 hours notice, I can give anybody, 20, 30, 40 minutes.
That's tremendous. That's so generous of you. So John at ToroRep.com, which is TOROREP.com. So listeners, there you go. Another generous guest that's willing to offer direct consultation with you, which, it's amazing to me how often that is the case, that you're generous enough to take an hour out of your life and open up your playbook and share with us what you're doing and how you've done it. And you're also willing to do it on a one-on-one basis. It's just a tremendous value. So listeners, take advantage of that. You know how to reach me, investwithgreenlight.com. You can book an appointment with me there anytime, no strings attached. We'll just talk about whatever you need. So John, brother, appreciate it. Thanks again. It's been awesome to have you. And appreciate it, and wish you all the best, and stay in touch. Okay.
Sounds good, brother. Thank you for having me.
Yeah. Listeners, thank you listening to another episode of the Apartment Gurus podcast. We appreciate you, and we'll see you in a couple of days on the next episode. Take care, everybody.
This has been the Apartment Gurus with Tate Siemer. If you enjoyed this episode, be sure to subscribe and leave a rating and review on your favorite podcast platform. To contact Tate, go to www.investwithgreenlight.com for access to his investor portal and Calendly link. He loves to hear from you and thanks you for being a valued listener. Just a reminder that you are the guru. See you on the next episode of the Apartment Gurus.